Today is cash trash now? Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. And just before we start, a word of thanks to our subscribers. We've just tipped over 60,000 subscribers on YouTube, which is amazing. Thank you very much for all of those who have subscribed. And if you're watching this and you're not a subscriber, please do subscribe, because in a few weeks' time, I'm going to change the settings on the site so only subscribers will be able to comment. That's in a bid to get rid of the nonsense spams that we've got. We have a lot of people spamming various crypto solutions and also various phone numbers which are completely spurious as well to places like WhatsApp. So hopefully that will make the site a little easier to use for those who don't want to be interacting with all the spam. It takes me quite a long time just to try and keep it all pruned. So as we approach the halfway mark through the year, it's important to note that US stocks are on track to mark their worst first half in more than 50 years. The S&P 500 is down around 18% year to date, and it's on track for its worst first half in a year since 1970, and the NASDAQ is closer to 30% down as the Fed tightens monetary policy in its fight against the highest inflation in decades. So relative to holding cash since the start of the year, stocks have been trashier. And bonds, which investors typically count on to counterbalance stock declines in their portfolios, has fared little better. The US bond market, as measured by the Vanguard Total Bond Market Index, is down 10.8% for the year to date, putting on pace for its worst performance in modern history. That said, of course, the value of cash is being deflated in real terms by high inflation, so it's not perfect. But lessons from history suggest that sometimes it's a reasonable holding place until markets bottom. And with investor expectations fluctuating between continued high inflation and an economic downturn caused by a hawkish Fed, few believe the market's volatility will dissipate anytime soon. It's worth remembering that on Thursday, Fed Chair Jerome Powell said the central bank's focus on curbing inflation was unconditional, adding to fears about more interest rate hikes. We don't expect the choppiness and volatility we've seen over the first half of the year to subside, said Timothy Broad, global head at Goldman Sachs Asset Management. But in fact, historical data paints a mixed picture of the trajectory markets may follow in coming months. On one hand, sharp falls in stocks have often been followed by steep rebounds. Past years in which the S&P 500 was down at least 15% in the midpoint saw the final 6 months higher every single time, with an average return of nearly 24%, according to data from LPL Financial, on market declines since 1932. And the S&P did rally more than 3% on Friday for its biggest one-day percentage rise since May 2020, as signs of slowing economic growth led investors to dial back expectations over how high the Federal Reserve will raise interest rates to rein in inflation. For the week, the index was up 6.4%, but then, of course, this may simply be a bear rally. Plus, one factor that may sustain that rally in the short term is quarter-end rebalancing, as institutional investors such as pension funds and sovereign wealth funds draw on record cash levels to bring allocations to stocks back in line with their targets. That phenomenon could lift markets by as much as 7% over the next week, according to JP Morgan. Meanwhile, several so-called contrarian indicators tracked by analysts at BofA Global Research, including cash allocations and investor sentiment, are flashing buy signals, they said. Jan Johansson, lead portfolio strategist and portfolio manager with Naxos Investment Managers Solutions, believes the second half of the year is likely to be better than the first, and he's growing more bullish on equities, particularly shares of beaten down big tech companies with strong balance sheets such as Google parent Alphabet. There is a lot of bad news priced in on the economy, he said. We think the risk is in to the upside. However, investors holding on for an eventual turnaround may be in for a stomach-churning ride. A study of bear markets over the past 150 years by Solomon Trades, head of North American quant strategies at Societe Generale, showed that stocks tend to bottom once they correct the excesses of the previous bullish period. And that would entail the S&P 500 falling another 22% to 3,020, according to their research, which measures percentage declines during past crises of similar magnitude. The market sell-off is an inevitable needed correction for the post-COVID excesses, he said, describing a stimulus-fueled rally that saw the S&P 500 more than double from its March 2020 lows. And skepticism on the sustainability of a market rebound extends to individual investors as well. A survey by the American Association of Individual Investors in the week ended June 22nd found that 59.3% believe that the US stock market will be bearish over the next 6 months. And Brian Jacobson, senior investment strategist at Allspring Global Investments, believes a recent decline in bond yields may help tamp down volatility across markets, providing opportunities in areas such as emerging market equities and short-duration high-yield bonds. For now, though, he remains cautious on the US stock market. From a sector perspective, nothing screams safe, he said. And Goldman Sachs, meanwhile, believes that inflation concerns and high commodity prices are likely to make the second half of the year as volatile as the first. There's downside risk in stock and bond markets. In an environment like this, they said cash is king. And adding to concerns of slowing economic growth, US initial jobless claims reached 229,000 last week, hovering near a 5-week high. And with the housing market showing signs of cooling, new home sales data for May was unexpectedly strong, rising an annualized 696,000. But the final reading for the month from the Michigan Consumer Sentiment was a tepid 50, slightly lower than the 50.2 expected, and that's the lowest since the late 1970s. Although the survey did also show that longer-term inflation expectations had not broken above their recent range, as a preliminary reading just before the Fed's June policy meeting had suggested. It's worth recalling that Fed Chair Jerome Powell cited the initial read of 3.3% as a possible early warning that months of 8% plus consumer price inflation were beginning to undermine public faith in the Fed's ability to contain price pressures. And that was one reason they gave for supporting the big rate increase in June. Respondents said they expect inflation to rise to 3.1% over the next 5 to 10 years, down from that preliminary reading of 3.3%. So it's really hardly a big move. And they see prices advancing 5.3% over the next year, matching the initial figure. Overall, the late June revisions of the long-run inflation expectations was generated by growth in the share of consumers expecting extremely low inflation in the year ahead, Joanne Hoos, director of the survey, said in a statement. About half of these consumers expressed bleak views about the risk of recession or unemployment during the interviews. The inflation expectations results earlier this month did play a key role in the Fed's decision last week to raise interest rates by the most since 1994. Chair Jerome Powell said the Michigan data, along with other recent inflation metrics, helped steer policymakers towards a 75 basis point hike rather than 50 basis points. And Fed Chair Jerome Powell acknowledged in congressional testimony this week that recession was a risk, but he also said the economy was strong enough to withstand successive rate increases. Bringing down inflation is the US central bank's number one priority right now, but raising interest rates to do so is unlikely to trigger a recession, San Francisco Federal Reserve Bank President Mary Daly said on Friday. The central bank's 75 basis point interest hike last week to a range of 1.5 to 1.75% puts policy on an expeditious path to neutral by the end of the year, she said in remarks prepared for delivery at Chapman University. After that, I see additional tightening beyond neutral as the next likely step. Markets quickly priced in even more aggressive rate hikes, with interest rate futures reflecting expectations for a policy rate of 3.5 to 4% by the end of the year. And a stream of analysts and at least one former Fed policymaker raised the alarm on recession risks. Exactly how high rates need to go will depend largely on factors outside the Fed's control, she said. That is a point that Fed Chair Jerome Powell also emphasized because much of the current inflation stems from rising energy and food costs related to Russia's war in Ukraine and ongoing supply chain and labour supply constraints. But the horrible truth is a lot of it is actually simply due to the quantitative easing and the massive amount of money creation that they did over the last few years. If supply continues to fall short and inflation remains high, we will need to do more, Daly said. If conditions improve and supply bounces back, we can do less. Either way, she said, the economy will likely slow and the unemployment rate will likely rise from the current 3.6% level. But it is not likely to lead to the kind of painful recession that followed in the 1980s, which was the last time the Fed raised rates sharply to fight inflation, she said. The costs of adjusting to higher interest rates and slower growth will be smoother this time around, she said, in part because inflation expectations are much better anchored, and in part because higher rates should cool inflation by reducing excess demand for goods and labour well before they start to cut into actual production and employment. I do expect the costs of adjustments to be moderate, with some slowing of GDP growth below its longer run trend and an increase in the unemployment rate from the very low levels we see today, she said. This would, to my mind, constitute a relatively smooth transition from a pandemic-racked, highly accommodative economy to one in which tighter policy supports both full employment and price stability. Daly's remarks are particularly striking because she's not known as an especially hawkish policymaker. And she said that by the end of the year, rates should get to 3.1% in her view of a neutral rate, although if inflation worsens, the Fed might need to do more. And speaking earlier in the day, St. Louis Fed President James Bullard said the Fed must act forthrightly and aggressively to get inflation to turn around and to get it under control, repeating his call for front-loading hikes to bring inflation down to the Fed's 2% target. And Bullard, since last summer, has been one of the Fed's most vocal hawks. Both Daly and Bullard expressed confidence the Fed will be able to avoid recession, citing the strength of the labour market and economy's momentum, helped by excess household savings that Daly said had not been spent down as quickly as she'd forecast. Interest rate futures traders paired their expectations for Fed rate hikes, and though they continued to price in a 75 basis point hike in July, ended the day reflecting expectations for a year-end Fed rate of 3.4%, exactly what Fed policymakers' own forecasts suggest. Anyhow, on Friday, the rally showed investors determined to end the week on a high note after putting fears about aggressive rate hikes by the Federal Reserve on the back burner, and that was breaking a 3-week losing streak, which had been led by tech. The Dow Jones Industrial Average was up 2.68% to 31,500, while the S&P 500 was up 3.09% to 3,911, and the NASDAQ Composite was up 3.34% to 11,607. It's the first positive week for stocks since the beginning of June, and investors have been concerned about a recession ahead of several Wall Street economists raising the odds of one happening sometime in the next 12 months. Carnival Corporation rose 12% after the cruise operator said second quarter revenue increased nearly 50% from the first quarter, and shares of auto dealer CarMax rose 7% after it beat earnings expectations despite a challenging environment. And FedEx Corporation jumped 6% after earnings beat estimates on higher rates and fuel surcharges, which overcame declining shipping volumes. The logistics giant released an optimistic forecast for 2023. Oil rebounded with crude oil WTI futures up 2.68% to $107.08 a barrel, while Brent oil futures were up 2.6% to $112.53. And by the way, gold futures was flat at $1,828. Oil prices settled up by more than $3 a barrel on Friday, supported by tight supply, but they notched their second weekly decline on concerns that rising interest rates could push the world into recession. The US Federal Reserve was talking very hawkish, which was undermining the oil rally, but sentiment is changing a little, especially on strong economic data, said John Kidliff, partner at Again Capital in New York. Russia's invasion of Ukraine exacerbated tight supplies this year, just as demand has been recovering from the COVID pandemic, and oil came close to an all-time high of $147 reached back in 2008. Crude has gained support from the almost total shutdown of output in OPEC member Libya due to unrest. And on Thursday, the Libyan oil minister said that the National Oil Corporation chairman was withholding production data from him, raising doubts about figures issued last week. Stephen Brennock of oil brokers PVM said recession fears dominated sentiment. Yes, the consensus remains that the oil markets will see high demand and tight supply over the summer months, thereby limiting the downside. The Organization of the Petroleum Exporting Countries and its allies, known as OPEC Plus, will meet on June the 30th and are expected to stick to a plan to only slightly accelerate hikes in oil production in July and August. US energy firms this week added oil and natural gas rigs for a second week in a row to a record 23-month streak of increases as high crude prices and prodding by the government prompted drillers to return to the well pad, energy services firm Baker Hughes said in its closely followed report that was out on Friday. Now, it's interesting to note that the latest weekly US oil inventory figures, which normally gives a snapshot of supply tightness in the top consumer markets, has been delayed to next week due to, quote, technical issues. And we'll see what that means. And shares in the biggest US banks rallied on Friday after they passed the Federal Reserve's annual health check. But Bank of America underperformed, with test results implying its need for a larger than expected capital buffer, which could limit share buybacks and dividends. And while the broader equity market also rallied on Friday, Wells Fargo was up 7.5%, and that was the biggest gainer among the 34 lenders that underwent the Fed's so-called stress tests, which measures how they may fare in a hypothetical severe economic downturn. The group would have roughly twice the capital requirement under Fed rules in a downturn scenario, it said. The big picture is that banks are extremely well capitalized and could manage through a downturn, David Conrad, analysts at Keefe, Bruyette and Woods, said. But the results implied a big variation in the size of banks' stress capital buffers, an extra layer of capital banks must hold to cover potential losses and support their daily business, which the Fed will set in coming weeks. And banks expected to have to hike their stress buffers were Bank of America, Citigroup and JP Morgan Chase, causing their shares to underperform on Friday. Morgan Stanley analyst Betsy Grex said Bank of America, Citi and JP Morgan may need to keep dividends flat and eliminate buybacks. Those changes are likely to reduce Bank of America's earnings per share by 1 to 2%, who dropped her price target for the stock to $47 from $49, and she estimated a 1 to 5% impact on Citi's EPS and cut her price target for that stock to $57 from $60. And JP Morgan's EPS will drop 1 to 2%, she estimated, lowering her price target to $149 from $152. KBW's Conrad also estimated that the three banks' buybacks will have to be materially adjusted downward. He sees the buyback adjustments shaving about 5% off EPS at the Bank of America and reducing EPS about 2% at JP Morgan and Citi. Wells Fargo investors, though, were relieved as its stress capital buffer is expected to remain almost unchanged from last year, Conrad said. The broad S&P 500 Financial Services Index closed down 0.46% to 519. And the US units of foreign banks performed well. The UBS Group closed up about 6%, while Credit Suisse added 5.5%, and other strong performers included Ally Financial, up 5%, and Discover Financial Services, which climbed 5.4%. And European markets moved higher on Friday, adding to momentum from a late rally on Wall Street, but sentiment remains cautious as recent economic data points towards a potential downturn in growth. Europe's stock 600 index rose 0.87% to 405.90, and the DAX in Germany rose 1.59% to 13,118, while the CAC In France, lifted 3.23% to 6,073. And in the UK, the FTSE 100 index was also in the green, up 2.68% to 7,208. This as investors shrugged off a decline in retail sales in May. Later in the day, UK consumer confidence also dropped to a record low, with market research firm GfK saying its measurement of sentiment dropped 1 point to minus 41 in June. And a couple of local election results went against Boris Johnson's Conservative Party as its chairman resigned. The upticks came as headline German business confidence fell by more than expected to 92.3 in June, according to an IFO Institute survey, pointing to broader pessimism in the manufacturing and services sector in Europe's largest economy. The euro-US dollar traded 0.9% higher at 1.0554. In Asia, the markets were stronger, with the Nikkei up 1.23% to 26,491. The Hang Seng in Hong Kong was up 2.09%, and the Shanghai Composite was up 0.89% to 3,349. The International Monetary Fund has called on China to accelerate its coronavirus vaccination program, warning the sharp slowing pace of new doses administered could undermine a recovery in consumer spending in the economy. At the current pace, providing 3 doses of COVID vaccines to the population would take a matter of years, Helga Berger, head of the IMF's China mission, said in an interview. With spending growth yet to recover to pre-pandemic rates, partly because households are cautious about COVID infections, an acceleration of the vaccination campaign would support confidence and ultimately consumption, she said. About 325 million people over the age of 15 in China have yet to receive 3 doses of the vaccine, while their daily vaccination rate has fallen below 800,000 per day. Studies have shown that 3 doses of China's domestic coronavirus vaccine are nearly as effective as mRNA vaccines in preventing severe infections or deaths. The low rate of full vaccination, particularly among elderly people, is one of the reasons China is persisting with its strict COVID-0 policy, requiring limits on activity wherever virus cases occur. Only about 64% of Chinese people over 60 have received 3 doses, according to China's National Health Commission. And Berger said that the lockdowns in Shanghai and dozens of other cities since March are a key risk for the IMF sees downside risks to its April forecast of 4.4% growth domestic product growth for China this year. The second quarter will be weak given the lockdowns, he said. While national data was largely returning to pre-lockdown levels, Berger added that in Shanghai, measures of economic activity monitored by IMF have recovered only to 50%. Now, here in Australia, a rebound in beaten-up technology and lithium shares lifted the Australian share markets on Friday as investors hunted for value and assessed the damage from this month's sell-off. The S&P ASX 200 rose 0.77% to 6,578 on Friday, taking its weekly gain to 1.6% as the benchmark snapped a 2-week losing streak. It was the share market's best performance since the week ending March the 18th. Lake Resources jumped 15% to 80.5 cents, recovering most of its losses from Thursday's 16.7% plunge. The company's chairman, Stu Crow, hit back at short sellers and spruiked a series of potential board appointments in the live webinar. There is a lot going on, and I also think there's a risk in the short term when we announce some of these positions, he said. The quality and the caliber of these people we're looking at to shortlist are nothing short of exceptional. The stock has dropped 48.7% in the first week of its inclusion in the S&P ASX 200 index, following the sudden resignation of Managing Director Stephen Promitz on Monday morning. And lithium miner Vulcan Energy jumped 26.8% to $6.34 after announcing it had brought European auto-making giant Stelios on board as its second largest shareholder. Stelios snapped up an issue of €60 million worth in shares in Vulcan, giving it an 8% share stake. Other lithium stocks also bounced, with Liontown Resources up 10.8% to 97.5 cents, Pilbara Minerals climbing 8.8% to $2.23, and Allchem firmed 4.7% to $10.08. The market is still so volatile, and today's moves seem to be investors looking at some of those beaten up stocks and asking if they've perhaps been hit too hard, said Russell Kessler, head of investments and capital markets at Van Eyck. The interest rate sensitive technology sector rallied 6%, tracking a strong lead from Wall Street, where the NASDAQ climbed 1.6%. Some of the companies worst hit by this year's technology rout found a bid, but there is still nursing heavy losses from the rotation away from riskier assets. Zip jumped 21.6% to 53.5 cents, but is down nearly 90% this year. And Live 360 advanced 24.9% to $3.01, but it's fallen almost 70% year to date. And Megaport rose 15.9% to $5.60, but it's also down about 70% this year. The energy sector was the day's biggest laggard as concerns about a recession pushed oil prices lower. Brent crude has shed more than 10% in the past fortnight because of fears of slowing demand. Beach Energy dropped 2.5% to $1.58, Santos fell 1.8% to $7.22, and Woodside Energy tumbled 1.7% to $30.61. Copper prices dropped to a 16-month low, weighing on Oz Minerals, which fell 2.1% to $19.19. And the major miners also extended their declines despite a rebound in iron ore prices overnight. BHP fell 1.2% to $40.02, and Rio Tinto declined 1.2% to $101.40. Base metal prices have suffered as investors fear an economic slowdown will hit demand. The major banks were mixed. NAB fell 0.4% to 27.02, ANZ tumbled 0.7% to 21.91, Westpac declined 0.8% to 19.48, while Commonwealth Bank added 0.5% to $90.16. And Qantas dropped 1.6% to $4.45 after saying it would be able to reduce net debt to $4 billion by the end of the month, meaning it's paid off $1.5 billion in the past half year. And Jetstar boss Gareth Evans said he would leave the low-cost airline next year, and Qantas said it would peel off capacity in the 2023 financial year to cope with high fuel prices stemming from Russia's war in Ukraine. And bet makers soared 20% to 36 cents after announcing it would conduct an on-market share buyback of as much as 10% of the company. And cryptos remained volatile and very weak, with Bitcoin up 1.17% to 21,269, Ethereum 6.16% to 1,221, as more bad news flows. The latest is from US crypto firm Harmony, which said on Friday that thieves had stolen about $100 million worth of digital coins from one of its key products, the latest in a string of cyber heists on a sector long targeted by hackers. Harmony develops blockchains for so-called decentralized finance, peer-to-peer sites that offer loans and other services without the traditional gatekeepers such as banks and non-fungible tokens. The California-based company said the heist hit its Horizon Bridge, a tool for transferring crypto between different blockchains, the underlying software used by digital tokens such as Bitcoin and Ether. Thefts have been long plaguing companies in the crypto space, with blockchain bridges increasingly targeted. Over $1 billion has been stolen from bridges so far in 2022, according to London-based blockchain analytics firm Epilik. Harmony tweeted that it was working with national authorities and forensic specialists to identify the culprit and to retrieve the stolen funds without giving further details. And in a statement, Harmony also added that it had a global team working around the clock to address the issue. We're currently narrowing down the potential attack vectors while working to identify the culprit, a spokesperson said, adding that Harmony had already tried to contact the hacker via a transaction on their crypto wallet address. Epilik, which tracks publicly visible blockchain data, said the hackers stole a number of different cryptocurrencies from Harmony, including Ether, Tether, and USD Coin, which they later swapped for Ether using so-called decentralized exchanges. In March, hackers stole around $615 million worth of cryptocurrency from Ronin Bridge, used to transfer crypto in and out of the game Axie Infinity. and the United States linked North Korea hackers to that theft. So standing back, the economic outlook is generally gloomy. Economic growth has slowed down. The IMF cut its forecast for global growth this year to 3.6% from 4.4%, which had been expected in January, and from 6.1% back in 2021, while inflation is still well above 8%. There is a war in Europe, and the Fed is tightening its monetary policy and financial conditions. Such a mixture won't end well. Given how high inflation is already, I don't believe that the Fed will engineer a soft landing. There will be a recession at some point, but of course it's all a question of timing. On one hand, the Fed may bring inflation under control. However, to do this now, when inflation is already high, it would have to raise interest rates and tighten monetary conditions in an aggressive manner that would likely cause a recession. The second scenario is that inflation remains unchecked and produces sufficient economic distortions to lead to the recession on its own. So one way or another, an economic downturn is coming, which is why I think markets will remain weak in the second half, and perhaps cash is your friend for now. We will see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.